everybody. Welcome to the Bob Knakal Show. I'm your host, Bob Knakal. So what was the first Manhattan deal? I'm sure you remember it.
The first Manhattan deal, yeah, I sure do remember it. It was a company called Tower Realty Trust. So again, the way we were growing was when we went to a market, so in the New York metro area, we would buy scale, right? We didn't buy a building, we bought scale. And New York was the hardest market to get in, right? By 98, we were in all the other markets, but New York, as an outsider, is very difficult to get in. And fortunately, there was this company that just had gone public. It was sort of a maker REIT, they used to call them at the time. They did a lot of acquisitions, enough to get scale, and then went public. And Morgan Stanley and a few other institutional investors were on the board and lost confidence in the management team. And it became very dysfunctional. So we went in and made a deal to buy the public company. The issue that we had, again, was that it was much bigger than we could have handled on our balance sheet alone. And it had assets in Florida and Arizona. And so for us to buy it, it would be inconsistent with what our shareholders want us to do based on what I said earlier and the scale. So we actually brought in Richard Rainwater and Crescent, which was a big investor that had properties in those areas. And they came in to buy the company with us. And they were going to take Florida and Arizona, and we were going to keep the New York City assets. And actually the Class B assets, we cut a deal with SL Green before. It was actually the first time I met Mark Holliday, because it's like his first day on the job, to buy our Class B assets, and we were keeping the Class A assets. So we bought it up. We're buying the company to break it up into pieces. The challenge is everything in real estate is that we had the Russian bond crisis, if you remember, in 1999, that basically roiled the whole markets, right? Everything sort of stopped. And so now we have this gigantic commitment to buy this public company for billions of dollars, and our stock price has tanked. The capital markets aren't open. We can't get debt. And then the worst thing happened, which is that Crescent said, we're not going forward anymore. And so they left us at the altar. And at the time, what we had with them was that we were joint and several on the contract. So in theory, they had to be put up their half of the money. But in reality, if they're not going to put up half their money, we'd have to go sue them to go get their money. So it was a very stressful number of months and renegotiations, and ultimately.
Yeah, so what happened? How did you get out of that pickle?
A lot of whiteboarding. And ultimately what we found was some negotiating leverage in a tax issue that existed in the company that became a material enough diligence item to at least throw a grenade in the middle of the table and blow it up a little bit and get everyone to regroup, and then got Crescent to come put some money into the mix and got the company to restructure the deal, and then sold off the other assets out in New York and got it closed. And that was our first deal. And then we did 919 Third, and then off to the races from there.
And that was a tumultuous time, because not only did you have the Russian credit crisis, soon to follow the dot-com bubble burst, right, then Enron, 9/11, that was the broader recession nationwide. So that was a really challenging time to start getting into the biggest market in the world.